From CTKSnews.com, we saw an incredible outcome inside the market. The non-farm payrolls, or NFP, came in at 336,000 versus a forecasted 170,000. This jolted the market. Later that day, consumer credit change came in and it was down 15.63 billion. That was a huge amount and reminiscent of the pre-fall that accompanied COVID-19. Just one day ago, there was a 20.1% probability of a 25 basis point increase in the federal funds rate. It's now almost halved to 11.2%. Many people will just say global markets are coming up, everything is fine, everything looks good. And we can see the main stock market did really well. That of course spilled over into crypto. Inside the masterclass, we do deep dives into the intercorrelations and interconnections between markets, and we know Bitcoin cannot escape the stock market's gravity. If you know that rule number, please let me know in the comments. Rule 4, price moves in waves, is an incredibly important rule. Global markets have sold down very, very hard for 11 weeks in a row in some charts. This is causing a massive amount of oversold behavior. Bargains are everywhere. The main markets are starting to move out of extreme fear into just plain old fear. The primary reason for that is that we're just so oversold. We're unbelievably and undeniably oversold. We expect some degree of mean reversion. Looking across the main markets, we saw that the VIX came down slightly. When fear goes down, markets go up, and that's exactly what happened inside the Nasdaq. The 10-year spiked all over the place, but basically it went up, and we saw that bond prices went down. With the incredible rise in yields, gold has been punished, and it's been punished because of the rise in the DXY as well. We saw some retracements there, and gold took a sigh of relief. The thing to keep our eye on right now is junk bonds. Junk bonds is decaying. The financial markets are a mystery until we understand that the Tier 1 charts are dominating price behavior across global markets. And when we look at the DXY, it bottomed out around 84 days ago, and it's been on a tear ever since. It's slightly weakening at the current time. When the NFP came out, there was a big surge in the dollar that was quickly faded. That was because the dollar hit a strong structural level at 106.9148 and couldn't hold it. It couldn't hold the lower structural support level either at 106.7242. If it's not going above, it's going below. The next smart money structural support level was at 106.4317, and we see it didn't hold that either. The DXY became weak, but it's been caught by several smart money support levels at around that 106.0828 level, and we realize that the DXY has been on an absolute blitz. This is an example of price moving in a wave. Yields have been going up for 154 days. If we zoom in to recent price, yields are starting to look weak, the US 2-year yield, but when we look at structure, that is simply not the case. When the NFP report came out, and it was just a blowaway report, the US 2-year yield absolutely and utterly spiked, and then was consequently faded. But it did go up. And when we look at the structural levels, these SLs from 512.32 up to 512.68, they created a lot of internal resistance in the market. These are literally structural resistance levels. These are where smart money is hanging out, looking to push the price down. Under here, this is smart money buy levels, structural levels, where smart money is looking to push momentum up. We can see that that momentum was just too much. It came down, tested support, and is showing strength at the current time. Because the markets are massively oversold, it is possible for yields to retest these structural buy areas, but just keep your mind on the fact that it's been reacting very positively and is not dipped down. We could see a re-challenging of this 512.47 mark. please keep your three-dimensional risk management on you at all times. The US 10-year yield has been on an absolute roller coaster ride up into the stratosphere for 183 days. The key to profitable trading and investing is to stack probabilities, especially across the Tier 1 and Tier 2 charts. What you're looking for is structural resistance and structural strength. From a short-term perspective, we can see that the US 10-year yield and the 10-year has been trading since 1912, so this is a very small window on price, but we can see it's starting to have trouble. We could be looking at a minor retracement here. As we know, the global markets are completely oversold at the current time. The NFP report was always going to be the really important report, and when it just blew through expectations, look at what it did to the US 10-year yield. It absolutely rallied it. The question is, why did it come down? Well, the truth is, it actually went up. It went positive for the day. Each time you make a loss, or each time things don't go your way, make a rule. And the rule for this one, everybody expected it, so the big institution said, no you don't. The maximum point of certainty is the maximum point of loss. And we're seeing right now that the US 10-year yield is coming up. This will continue to put pressure on the major indices, stocks and also crypto. Price is always moving in a way from structural level to structural level. So when we turn on the monthly indicator, and these are all structural levels that have been drawn up with the standard space CTKS method since 1912 for the US 10-year yield. These lines are very significant. They're not pretending to be support or resistance, they are actual support and resistance lines. We see this all the time inside the crypto market. You can get big exponential explosions in price followed by implosions because the structural levels just get hit. When you get up to a structural level, when price is down here, these are all structural levels, and the thicker ones are stronger ones. When they're clustered, they hang together, they're stronger. And this is exactly what happened. The strength of the sellers just came in and pushed it down. What did it push it down to? It pushed it to support. We're now currently seeing strength in the US 10-year yield. We wouldn't be at all surprised if we just came up and tested this 4.8459. If the markets continue to retrace, that is mean revert, we would be looking to test this 4.7622 level. Price reality must always be your guide. Gold has been severely hammered by the upward momentum inside yields, and you can see what's happened to gold's price action. It's currently 1832. When non-farm payrolls came out, gold took an absolute hit, but I'll show you the structure that sits underneath gold. And what did we see? A retracement. You can see that this is very inverted US 10-year yield behavior. Financial markets are always moving between structural levels. Price comes down to structural support, finds it, taps it, tries to get through structural resistance. If it manages to, it's going to the next one. If it can't get above, it's going below. This makes it very easy to understand where price is actually going, using price reality as your guide and not stories. These structural levels come from 1833. Members of the service, I released a video yesterday that explained how much structure we have inside gold, and important things to look for as well. The NFP report, when it came out, it shocked the S&P 500. The spike in yields caused the main markets to come down, and then they recovered. The yield trade is getting very, very overcrowded. We've seen this in the past with oil trades. As soon as everybody says it's absolutely guaranteed, well, that thing tends to go in the opposite direction. The point of maximum certainty is the point of maximum risk. I've just overlaid the US 10-year yield here. If we invert this price, we see something particularly interesting, a potential weakness in the S&P 500. The S&P 500, marked up since 1871, has been released into the service. What you can see is all this structural resistance at 43.14 and lower levels and higher levels is stopping and slowing the S&P 500 currently, but all charts are intercorrelated and interconnected. This means if the yields continue to come down, they continue to mean revert. We would expect the S&P 500 to break through this resistance. If the yields spike again, we would expect the S&P 500 to at least check this particular structural support level at 42.92 first. If it can't hold that one, it's going to 42.75. As price is always moving in a wave, we need to understand that things can wave up and wave down and then wave back up again. So we're keeping our eye on these structural resistance levels. They're the key ones to watch. Also your structural support. It's a very simple rule inside financial markets. If price gets above a structural level, it's going to the next one, if it can maintain that positive momentum. If it gets down to a structural support level, it's going to the next structural support level unless it can hold that level. All charts are intercorrelated and interconnected. When the NFP report came out, Bitcoin just slid. It literally was 27,750 and it slid down to 27,202. And then what happened? You remember the yield spiked up and then came down. The US 2-year, the US 10-year and the DXY all did fairly similar things. And remember what happened just to the S&P recently. We can see that similar pattern playing out on Bitcoin. We know the price moves from structural level to structural level. So where were the structural levels? There was structural support at 27,356. Also 27,288. And a lower one at 27,235. There are multiple support and multiple resistance levels that play out inside price structure. Retail support and resistance levels say that there's basically one support and one resistance. This is not the case, and it never was. Instead, what you actually have inside market structure are multiple supports and resistance levels. The support and resistance levels that I show you are structural support and resistance levels drawn for all of price action, not recent indicative price. In Bitcoin's case, we're talking about structural levels from 2009. Where can Bitcoin go next? If we look at Bitcoin's price action, there is a structural level playing out at 27,824. This is going to become a very key level. If we hit this level and bounce, we would expect to make our way up to 28,428. If we hit this level and we collapse under it, we may end up retesting it and moving back to structural safety nets around that 27,290 level. This is exactly why we need to know where the structural levels are, because if price falls off a cliff, it's going to get caught by these safety nets. Beatty calls them trampolines, and it will rebound the price to the next structural level. It's very important to keep this in your mind. A lot of people say, what is the support level? What is the resistance level? You're looking at them. These are structural support and resistance levels. These are the places that the algorithms and smart money hangs out. Bitcoin is a tier 1 chart. Another tier 1 chart is total crypto market cap with the ticker total. When the NFP report came out, we know that the spike in yields and the decay of the stock market forced total crypto cap down. And then we saw a recovery as yields started to decay. One thing that we're seeing inside total crypto market cap is that we are under a structural resistance level, and these levels have been drawn up since 2014 with the standards-based CTKS method. That price is 1.075 trillion. If we can't get above there, we're going below. Therefore, we would expect to hit this $1.067 trillion mark, and we're fortunate because there's another safety net below that at 1.065 trillion. But if we don't come down below, if we get above, the next structural level is that 1.08 trillion. price is always moving in a wave, that means it's non-linear. It's curvilinear, which means it's a wave function. It's always moving down, finding support, and moving up, finding resistance. If it gets through it, it's going to the next resistance level. If it gets through that, it's going to the next one. If it can't get through that, it's going to the one below. But if it's showing weakness, it's going to the one below that. This is how you can let price reality guide your decision-making process. Every single trader and investor has a different style. The money means different things to different people. Some traders and investors can afford to lose 100% of what they put into the market. Some traders and investors have very long time horizons. Some have very short, not even past an hour. This means that any piece of advice anybody gives you should be treated with a grain of salt. Experts do not know your needs, and they never can. One person's goal is not another person's goal. Everybody is doing different things inside financial markets. Also, people take different positions in the market. Some go long, some go short. What we can see is the crypto market follows the main market. It always has, from a directional stance. Directional correlations can be tricky to understand. They're not like normal correlations that you would hear about. The greatest gainers in the past 24 hours, top 100, AVAX, Injective, Render, Stacks, GMX, TON, SUI, Flow and Matic. The greatest losers past 24 hours, top 100, Rune, Trust Wallet, Maker, ZEC, Bitcoin SV, NFT, Tron, Mantle and Gate Token. This is really an example of price moving in a wave. Over the last 30 days, Trust Wallet has been going ballistic, but it's the second greatest loser today. Your timing determines your profitability. Please keep your eye on the structural levels of the Tier 1 and Tier 2 charts, especially the Tier 1 charts. The Tier 1 charts give you the window into the health of global markets. They explain where the structural support and resistance levels are, and their movements can be mapped across different charts like I've shown you in this video. When you get an unexpected negative outcome, for example a loss, there are two ways to cope with it. You can go through the doom cycle or through the profit cycle. The doom cycle is in red. The profit cycle is in green. Professional traders and investors don't worry about going through the doom cycle. They've done that plenty of times. It just doesn't work. It compounds losses. But it compounds losses across everything. Finances, relationships, work, everything. It makes you absolutely miserable. Every single trader and investor goes through the doom cycle until they figure out it just doesn't work. At that stage, they enter the profit cycle, where they own what happens. They realize that they're the only ones buying or selling. Instead of blaming themselves and feeling bad, they look to what can I do better next time? How can I avoid this the next time? Blame focuses into the past, creating a doom cycle. Learning focuses into the future, creating hope, empowerment and control. The key is just to understand that financial markets seek to catch people off guard. The maximum point of certainty is the maximum point of loss and the maximum point of risk. However, looking at structural support and resistance levels, especially across the Tier 1, allows you to stack probabilities and to understand what can be occurring next. A probability isn't a certainty, but that's okay. When you stack more and more, you will see a bigger picture. Stacking probabilities is the definite way to go, and don't forget to hook in and have a look at ctksnews.com. It will help you. There's a lot of really good articles there. On the Market Analysis tab, you'll get a list of upcoming economic data release events. It's very, very good. And also you can see all US stocks across all sectors, as well as crypto market performance and many other things. Please let me know in the comments, where do you think the Tier 1 charts are flagging that we're going next within, say, the next week? Doing this active learning will make the entire difference in your profitability. Always remember, you control the trade or investment, but the market controls the return. And that return is always based on your active learning, your knowledge and your courage. and the market penalizes blame and gambling. When you get an unexpected negative event, i.e. a loss, just create a lesson from it. After all, that rule that you create, you paid for. So many times when people blame, they keep on paying for the same rule, but if they just created the rule, they wouldn't pay for it anymore because they would say, I see what's happening here, I'm not falling for that again. The key is just to remain in synchronization with the market. That means that we must stack probabilities. You can only stack a probability by looking at more than one chart. Two of the greatest causes of losses inside financial markets are blame and certainty. It takes time to stack probabilities to get used to probabilities versus certainties. A certainty is a probability of 100%. A real probability is always below 100%. Don't forget that your returns come from uncertainty. Your losses come from certainty. Entering the doom cycle just means that we end up paying for the same lesson time and time and time and time again. The markets do not care, they just care that you learn the lessons. The more lessons that you learn, the more profitable you become because you're not making losses. And you're identifying profitable rules that work for you. That's why keeping really positive is very important. We say inside the CTKS Creed, which are just daily positive affirmations for abundance, financial success and happiness. I am dedicated and committed. I win or learn and never blame. What we're saying here, we enter the profit cycle. To hell with the doom cycle, we don't want to go there. It's just barbed wire and broken glass. We say, we made the loss, we're going to learn the rule. And the next time we get to apply that rule, we will minimize the loss or avoid it. That already sets you on the path towards consistent profitability. Have a great day or night ahead, my friends, and a wonderful weekend. And Kate and I will catch up with you in the next video. Bye for now.